Hello, I'm Susan from CoVenture Tax Consulting. Today, I'm talking about the tax rates payable by individuals and companies on the sale of developed and undeveloped property. Advising on property transactions is one of the most complex areas of tax advice. This is because there are different rules for construction companies, investors, developers, land dealers, and private property owners. Understanding these rules is especially important for accidental developers, including farmers, private owners, and individuals who have inherited land. There are some nasty tax surprises for the unwary, and these are covered in this video. A company or individual who sells land or property held as an investment is liable to capital gains tax at 33%. A company carrying on a construction business which disposes of fully developed land is liable to corporation tax at 12.5%. Importantly, the 12.5% rate only applies to land on which a building has been constructed by or for the company before the disposal. The development must be to such extent that no further development would be expected for 20 years. A company that sells undeveloped or partially developed land that does not meet the conditions for the 12.5% rate, may be liable to corporation tax at 25%. In some cases, a person will be assessed to income tax at a whopping 55%. Unfortunately, these are usually cases where a sale is made without input of a tax expert. An assessment is raised, and the scope for avoiding the higher tax rate is very narrow because of the failure to take advice. A company must be carrying on a construction activity or selling fully developed land to access the lower 12.5% rate of tax. Whether a company is trading or investing will depend on the motive for acquiring the property and the activities carried on. Obviously, a property is purchased and/or developed as an investment if the goal is to generate rental income and long-term capital growth. Sometimes the intention can change and the tax treatment can be difficult to ascertain. A clear tax case must be built to protect entitlement to the lower rate. This is an area where clients often fall down and need help. Companies have to be careful to avoid exposure to tax at 25%. You should be mindful of this higher rate if dealing in undeveloped or only partially developed land. Land is regarded as fully developed and outside the scope of the 25% rate of tax if it is developed by or for the company to such extent that it could reasonably be expected that no further development will be required for 20 years. Irish tax law can override the usual 33% rate of CGT on property transactions, and instead apply the marginal income tax rate of up to 55%. The normal CGT treatment is set aside if a person is trading or, under tax law, deemed to be trading. There are a number of instances where a person is deemed to be trading, and these include situations where land is acquired through an inheritance and it is subsequently sold. The term trading is not defined in tax law. Instead, whether or not a trade exists will be determined on a case-by-case basis. The characteristics that indicate a trade include the motive for the acquisition of the property, how the acquisition was financed, whether the property is income-producing, the period of ownership, the reason for the disposal, and whether planning permission was obtained prior to sale. In 2018, the High Court held that an individual was trading when he purchased a property on Shrewsbury Road. The subsequent activity was liable to income tax, not CGT. The taxpayer owned a number of retail shops and a portfolio of investment properties. He bought a property with the intention of demolishing it and building 2 new dwellings. He never intended to live in it and had rented it to a neighbor for a short period. The acquisition and redevelopment was financed by several loans, and the taxpayer applied for planning permission. Ultimately, no physical development works took place on the site. The High Court observed that he borrowed to finance the development, he put the activity in train by agreeing to the purchase, he dealt with third parties, and, crucially, he hoped to make a profit. He was therefore engaged in the trade of land development subject to income tax. This case involved a person with significant experience of making investments. But what about an accidental developer or someone who inherits land? Let's consider the case of Mr. Field, who owns an undeveloped site which is used for farming. He didn't acquire the site with the intention of developing and selling it. He inherited it from his father. If he sells the site without any development, the sale is liable to CGT at 33%. This is the case even if he obtains planning permission. What if he develops the site by putting a road or services in? Will this alter the tax treatment? On one hand, he did not acquire the site with the intention of developing and selling it. He is taking actions that a careful owner would take to protect and possibly increase the value of the asset. But would the tax rules mentioned earlier deem him to be trading? This case is borderline, and the answer could go either way. The factors to be considered would include the degree of activity in terms of hiring contractors and advisors, and what, if any, other development projects he is connected with. This is a good example of a person who should take tax advice in advance of engaging third parties to carry out work or provide property-related services. It's clearly important to understand the rate of tax on gains from selling land and property. Individuals should take note of the risk of exposure to income tax at 55%, and companies should be aware of the risk to tax at 25%. Apart from the tax rate, many other tax issues arise daily in practice, including VAT, relevant contracts tax, stamp duty, residential zoned land tax, tax clearance difficulties, and more. There are many other property-related tax issues to consider, including the rate of tax on rental income, exposure to tax at 40% on rental income in companies, the tax treatment of short-term lettings and service buildings, and the inheritance tax exemption for family homes. So the range of possible tax rates are summarized here for easy reference. If you would like to discuss a property transaction with one of our tax lawyers, please contact our Dublin office at 69-78012 or email advice@coventure.ie. Thank you for listening to this video. If you found it interesting, you might like to visit our website or YouTube channel for more tax content.